Hey guys, Justin with Deep Dive Stocks here, and today we're going to be going over some of the report components to get a feel for what is on the reports, how to read them, and to just kind of get comfortable with them. I've had a lot of questions fielded my way lately just about what something is, how do we interpret it, and I thought a good quick video might be able to answer a lot of questions. We're not going to get too deep today into the integration of the data into like your trade or like portfolio performance, but rather we're just going to go over what's on the report, what the data are, how to read it, and then in later videos we're going to talk about each specific aspect of the report and how we can incorporate those data into our decision making. So let's go ahead and get started. The first on the reports, of course, is the VoEx graph. And the VoEx graph's design is to measure stability. And it does that by either being in one of three zones. But before we talk about those zones, let's get a feel for what is on the VoEx graph. There are three lines on the VoEx graphs. Well, there's a few more, but there's three that are important to us. The magenta is the VoEx, the tan line is the VoEx trend, and the blue line is the price. One of the questions I'm asked often is, does the position of the price in comparison to the three zones we're going to talk about have an effect or have a meaning? And the answer is nope. The VoEx graphs are completely designed and centered around VoEx, and so it is only the location of VoEx that is important to us. The price is there just so we can understand how VoEx is affecting the underlying stock price. With that in mind, the three zones on a VoEx graph are the inhibition zone, which is above the top horizontal line, the stable zone, which is between the two horizontal lines, and then the propagation zone, which is below the bottom horizontal line. And there are certain specific VoEx behaviors that we can look out for, not only, including VoEx being in the inhibition zone, instability, or in the propagation zone, but we won't get into that too much. I have a tendency to rant. If you're interested in those, in that information or in those data, definitely recommend checking out some of the other videos on VoEx or heading over to the website and reading some of the educational primers. There's tons of them. They're way too long. They're filled with really good information. I don't think they're too long. On the next page of the reports are the snap graphs. Now, if you've ever heard me describe or rant about VoEx, you'll see that sometimes it can feel at first a little hand wavy. And in order to get rid of that, I decided to create the snap algorithm, which quantifies VoEx down to the raw numbers and gives us a statistical analysis of VoEx's behavior. That way, if we ever, are a little hand wavy or saying things like, oh, well, this VoEx kind of reminds me of this, we can always turn to the snap graphs and just figure out what does the snap algorithm tell us in terms of how this VoEx behavior has responded, or how the price has responded to this VoEx behavior in the past. And the snap algorithms do that for us over 4 different time intervals. There's the 20-day, which is in the top left, the 10-day, which is in the top right, the 5-day, which is in the bottom left, and then the 1-day, which is in the bottom right. And quick disclaimer, typically when you hear inside of Deep Dive Stocks ecosystem 20 days or 10 days or 5 days, these are all trading days, which are really the only days that matter. So a 20 trading day return would be a 1 month time frame. So we have the 4 time intervals for the snap intervals, and we have the 4 components on each snap graph. The first one you'll note is the gold line that goes through. That denotes if the snap algorithm is giving us a positive expected return or a negative expected return. And it indicates that to us by placing the crosshairs either above that gold line or below the gold line. So in this example, we see that all 4 snap graphs have negative returns because the crosshairs are below the gold line on all 4 snap graphs, which for all 4 returns. The next component is the line, the squiggly line with the blue shading. That is the snap algorithm's model of the behavior of VoEx to price for this given stock. The highlighted region around that squiggle line is the 95% confidence interval, and that helps us decide if the current snap algorithm output is trustworthy or not. If the highlighted region is too large, or if it expands over the positive and negative areas of the snap graphs, well, we might need to look at some other data points because the snap algorithm may not be doing quite the good enough job of encapsulating VoEx's behavior. The last component is the pink dots, and those are just the individual data points that the snap algorithm utilizes in order to produce its model. These are included in the graphs because sometimes if we don't see a good clustering or we don't see that nice hourglass shape, it can be helpful to know that, again, the snap algorithm isn't really doing quite the best job at encapsulating VoEx's behavior, so we might need to go look somewhere else. Those are the snap graphs. The next on the reports are the I always want to say gamma gainers, the Gamma Hedging Heatmaps. These are the newest addition to the reports, and their job is to just monitor gamma hedging. And by way of monitoring gamma hedging, they also monitor delta hedging. The data suggests that they are incredibly accurate for a variety of reasons. And a prime example here is SPY's heat map from July 8th. And the next week, we mapped out the next week's price and volatility. And we see that as SPY fell into the purchasing support down here, it quickly bounced right back up. And so what do I mean purchasing support? Well, there's three zones on the gamma hedging heat maps. There's the selling pressure, which is red, the purchasing support, which is blue, and then the gamma neutral zone, which is white. So we see that when this data printed out on the 8th, if SPY increased in price, it would run into more and more selling pressure because the red is getting deeper and deeper. But if the price fell, we would see it would run into purchasing support, which is exactly what ended up happening. You'll note that on the x-axis, we have the change in volatility, and on the y, we have the change in price. The last component of the hedging heat map is the influence distribution. The influence distribution is not only statistically relevant for future price direction, but it tells us what the most anticipated future price direction is. So again, we see that on the 7th, we had an influence distribution that was just slightly negative. So it's relatively unsurprising that the index ended a week later just slightly negative. Pretty cool. The next graph rather is the expected price range and volatility graphs. The expected price range graphs have two components. The solid line is the price of the asset, in this case Apple, on July 15th, and it has the dashed lines, which are the 68% probability range for a given price as calculated by the implied volatility. So this tells us how well behaved a stock's price movement is as compared to what the expectations for that stock price's movement is given its implied volatility. Sometimes you'll note certain particular behaviors such as mean reversion, where a stock's price will bounce off of the upper expected price range limit and then fall pretty drastically. It's a pretty standard pattern. But the purpose of the expected price range graph is to identify if a stock is well behaved or not well behaved and to kind of factor that into any plays we might be making. The second graph down here is the implied volatility graph. In this graph, pretty straightforward, it just tells us the implied volatility on a stock over the same time period that we have the expected price range. The next graph is the shorting behavior, and we have three different time frames again on one graph. We have the light gray, which is the day-to-day shorting behavior, the light blue, which is the kind of the weekly shorting behavior, and then we have the long trend deep blue, which is the, again, long trend for the shorting behavior. This way we can see if the current behavior of shorting matches the established behavior or even more long-term behaviors. It is important to note that the shorting ratio used here is the short volume per day divided by the total volume ratio. And so next up, we have the options layouts. The options layouts have two graphs. On the left, it shows the static placement of the options per their strike and divided by if they're a call or a put. On the right, we have the change in the options on two different time frames. The first is the bars, and that gives us the change in the open interest at a given strike from the day prior. Gold bars indicate a decline or a decrease at that strike, and blue bars indicate an increase at that strike. A little hard to see on this particular options layouts, but the lines here represent the average daily change over the past 20 days. So that way we get to compare the current change with the average change on this stock. And so we see on Apple, for instance, and on July 15th, experienced quite the decrease up to almost 200% in the number of, what would those be, in the money calls and out of the money puts. Moving on, we have the data tables. So the data tables can be a little meaty, so we're going to go through each row one at a time. The top row has the price and volatility changes in both, so the current value at close, the close value from the day prior, and then the percent change between those closes. In the middle, we have just the standard options information, so how many of the calls are in the money, how many of them are out of the money, and then the comparison of the total amount of calls to the total amount of puts. And then lastly, we have the hedge requirement, and that is the total amount of shares that have to be purchased or sold depending on the change in the price and volatility, and that's calculated from the hedging matrix, which we will see below. So, for instance, on this stock, we see that with a 1.15% increase in the price and an 8.67% decrease in the volatility, that made a 9,176,312 million share selling requirement. So because of all of that price and volatility movement, 9 million shares had to be sold on this stock. That's pretty substantial. The second row has the delta table. The delta table can be a little intimidating at first, but I think it's pretty straightforward once you work through it. The delta table gives us two bits of information: the current value of delta and if it is positive or negative. And then inside of the parentheses, it tells us the change in the delta value as compared to the row below it. So let's work through this. We see the current delta is positive because it has a plus. And then we see that it is 71% less than the previous delta, or the delta from the previous trading day. The previous delta was positive because it's a plus, and it was 244% greater than the average delta over the past 10 days, which is delta 10. So delta 10 is the average delta over the past 10 days, and we see that for this stock it is positive, and that on average it was 701% greater than the average delta over the past 20 days, which is negative. So each row is in relation to the row below it. So that shows us that a month ago, or over the past month, delta was negative, and in the past 2 weeks has seen quite the surge in positive delta. This surge has tapered a little bit yesterday with only a 244% increase, shame, but the current delta is 71% lower than the previous delta, so perhaps we skyrocketed up in our long delta and we are slowly starting to come down. In the middle, we have the current, or the volume table, which tells us the current volume, the previous volume, the average volume over the past 10 days, and the average volume over the past 20 days. The next table is the shorting volume, or the shorting amount. So we have the current amount or volume of shares that were shorted, the previous short, or the trading day before, the average amount of shorting over the past 10 days or 2 weeks, and then we have the last reported open short interest from FINRA. We then combine all that data into the DTC, which is the days to cover, or the ratio of the open short interest to the average volume over the past 20 days, rounded down. The next row is the expected price range table. We already saw the expected price range graph from above, but the table tells us from today, tomorrow, over the next 20 trading days, what the 68% probability movement in that price is. So for instance, today's would be the day that the report is made. What was the expected price range? This can be helpful to compare with what the movement of the price actually was. Tomorrow's is the next trading day. And then T2, 3, 4, and 5 are the next 5 trading days. T10 is the next 10 trading days. And T20 is the next 20 trading days. The expected price range is given both in terms of its dollar amount, so the upper and lower boundaries, and also in terms of its percent movement. And this is calculated from the implied volatility, and again, it gives us the 68% probability curve, or the cone, that the market expects this stock to stay in. This can be really helpful when you're trying to decide which strike to place certain options at certain dates, because it gives you kind of this mathematical and statistical way of figuring out which strikes are the best. And so the hedging matrix, we've already seen the results of the hedging matrix above, which is the hedging requirement. The hedging matrix tells us how many shares have to be purchased or sold per movement in the price or the volatility. And the volatility. So for instance, on this stock, we see that if the price increased by 1 point or $1 and volatility increases by 1 point, then 541,873 shares have to be sold. So this helps us go in a point-by-point basis to figure out how many shares have to either be purchased if the number is positive or sold if the number is negative. Pretty nifty. Last but not least, and the one that I think gives the most people the most amount of anxiety, is the options directions table. This gives us the type and directions of options and how they've changed over 3 different time intervals. It's kind of I like having the progression of things. Static data points aren't that helpful, right? So we have each type of option. So for instance, we have calls that are in the money that are dealer long, and that's important to note. Almost all of the perspective that Deep Dive Stocks takes is from the perspective of the options dealer. And we have 3 numbers listed under each category of options. The first number is the percent change from the day prior. The second number is the average daily change over the past 5 days. And the third number is the average daily change over the past 10 days. Sorry, I had to think about that, even though it's right here. So this tells us, for instance, on Apple, that over the past 10 days, the daily change on average has been a 124% increase in the amount of dealer out of the money long calls. In comparison, over the past 5 days, the average increase has been 204%. And then the change from the day prior is 450%. So we can see a progressively increasing amount of dealer out of the money long calls being opened. And since those are dealer long calls, that means the market or the retail investor is selling those calls, which not only does this have a direct impact on the way that the options in the hedging affects the stock, but it gives a pretty good sentiment evaluation to Apple. It doesn't look like things are too bad or bullish looking when people are selling calls with an increasing amount of confidence. So those are all of the components of a Deep Dive Stocks report. I hope this has been helpful just to kind of give an overview on how to read the data, what it means, why it's there. In future videos, we're going to go through each individual component a little bit more in depth. We're going to look at what the data mean, how we can interpret the data, and then utilize those data in the management of our portfolios. So as always, thank you for joining and have a good one. Happy trading, guys. Bye.